What's up everybody, welcome back to my channel, Earn It, Save It, Invest It. In this video, I'm going to break down what I expect the stock market to do over the next few months. Now, I've been looking at the charts and looking over some technicals and some fundamentals. We have some earnings coming out, and I do actually think we have some danger coming along the way. That's why I have the hat with the D on it. I think there's some danger presenting itself. So I'm going to quickly go over why I think the danger, what the danger is, why it's presenting itself, and then what exactly is going to be the effect. What is it going to do? So if you do like these videos, you like my content, please give it a like and subscribe. I really appreciate it. And let's just break this down really quick. Here we have the three major indexes, right? We have the S&P 500, the NASDAQ, and the Dow. I left the Russell out because that one is not currently performing the same way as these other three. It's kind of been in its own lane for a while now. So I'm putting the S&P 500, the NASDAQ, and the Dow all together. As you can see, we're reaching all-time highs on all three of them, right? We're reaching all-time highs. Now, all-time highs do not necessarily mean that we're going to start going down. In fact, all-time highs usually signal more all-time highs. I do believe we're going to be getting all-time highs continuing over the years and over months, plenty of course, but I do believe there's a little bit of a hiccup that's going to be coming up, I think, very soon, and I'm going to break down exactly why. This is kind of one of the big reasons, right? We have the Qs. Now, there's no 100%. If you look on these, I don't see any 100%. I don't see any 0%. But I see some big ones. I see July and November at 90%. This is the seasonality of the Qs. You can see how often it goes up in a month or how often it goes down in a month over the last 10 years. Now, as you can see, July and November are its best months. But what are the weakest months? Other than February, which is pretty low, you have August, September, October. Those are your weakest months in the Qs. So just by looking at that over a 10-year span, historically, these are weaker months. These are harder months. They're weaker months. The summer's out, right? There's summer vacation for these people in a way. So, I look at the SPY, S&P 500. Not much of a difference, right? July, November, the best months. May is actually a little bit better than November, but it's because we just went through a May. And February is one of also the worst months, right? So you have August, September, and October as the worst months for the S&P 500. We have hit, over the last 10 years, the S&P 500 has been positive 100% of the time. And it's going to do it again this month. That's insane. So for the last 11 years, in July, the S&P 500 has been positive. In August, September, October, it's a little bit different, right? The odds are definitely lower. In August, they're still on our side in terms of getting gains, right? 6 compared to 4, right? Or 60% compared to 40. Well, the odds are on our side, but a lot less on our side, right? We look at the Dow, same thing. July, 100% in the last 10 years. November, 90%. It's not just a coincidence. August, September, October, and February, actually in March for the Dow, are the worst months. The next 3 months, August, September, October, are going to present themselves, I believe, as hard months to make gains. Big gains, especially. But maybe just any gains. Right now, one of the big things that we have going on is Donald Trump, our president, is fighting with our Fed chair, Jerome Powell. Essentially, Jerome Powell and the Fed have, they raise rates heavily, with COVID, and when they dropped the rates and they flooded the whole economy of money and cash, the stimulus, it created a bunch of inflation, so they had to raise the interest rates. And so then we're on our way down, and it stopped. They've paused it now for a little bit. And, Donald Trump wants them to lower the interest rates. And Jerome Powell is saying, well, we're not going to lower them right now based on X, Y, and Z, or A, B, and C, right? So they're kind of going at it. There's been even articles and news headlines about, oh, will Trump even fire Jerome Powell? And I actually have a video about what that would do if Trump were to do that, and it would cause a lot of chaos. I don't think it's going to happen. But Jerome Powell has until May 15th of 2026 for his term. Now, I do believe they're going to be fighting all the way up until May 15, 2026. I think that, excuse me, I think that Donald Trump is going to put someone in, he's going to try to put someone in that's more towards lowering the rate and not necessarily politically motivated, but, Jerome Powell was selected by Trump. So it's not like I'm going to sit here and be like, oh, he's going to be so heavily political. I mean, the guy who's in right now, who's going against Donald Trump, was handpicked by Donald Trump to do the Fed chair. So it is what it is, right? He will still be a part of the Board of Governors until 2028, Powell, but he is the Fed chair for about 10 months or so, somewhere around there, a little bit less now, right? But still, that's going to be something that's going to be happening for a little while. Here's the thing. Donald Trump does have a point, right? When you see how fast the interest rates have risen at times, they also fall, right? They fall because, okay, well, we probably overshot it. The Fed usually does that. The Fed will usually think it has to do something, and then they overdo it. And then in response, they have to reel something back. And then most of the times they'll overdo that. And so it's a constant like, whoo, whoo, right? That's why we have these swings in our economy. And yes, the Fed funds rate, right? Our federal rate the interest rate is just too high right now. When you look at our trueflation number, we're around 2%, and our Fed funds is at 4.3. It's just too high. It hurts us as consumers to borrow money, right? To do all that. It hurts us because now we're paying more to borrow the money. That being said, Donald Trump doesn't want necessarily the interest rate or the Fed funds rate to go down for the people to be able to have more borrowing power and stuff like that, right? That's not necessarily what it's for. The Fed funds rate indirectly affects government spending, primarily through its impact on the cost of borrowing for the U.S. government and the broader economy, which in turn influences fiscal policy decisions. While the Fed doesn't directly control government spending, that's fiscal policy, its actions on interest rates can create conditions that necessitate or facilitate changes in government spending. To break it down really quick, if Donald Trump and his administration want to spend money, they are paying an interest rate at the Fed funds level. They want to spend more. You will hear every president talk about, we need to bring down the budget and, how much the total debt that we have. The fact of the matter is they don't care. They're going to spend money. They're going to spend money. And Donald Trump, the administration, they want to spend money. But he's like, it's expensive for me. It's so much more expensive for me than it has been for any other president over the last 10 to 15 years. And it's harder for them to do stuff. And that's why he's doing it. Not necessarily for the people to have more borrowing power and more leverage, more cash in their pocket or less, interest to pay, all of that. Overall, it's more about the government having the ability to spend. And I say that because you look at our budget or our federal debt, and it's never gone down. This is since the 1970s, right? And you look at that. Let's go back, to the Fed funds rate, right? When you see the Fed funds rate has been on a consistent decline since the 1970s, right? In the 70s, we had a huge inflation, so the interest rate went up. But ever since basically the early 80s, it has gone down, down, down. Now we've had some spikes up, but we can consistently go down. Now, the crazy part is that are we ever going to see interest rates again that are as low as less than 1%? I don't know. I don't think so. A lot of the times these were done out of drastic changes, right? We had September 11, we had 9/11, we had that whole thing, and the tech bubble crash. Fed funds rate started dropping down. We had the great financial crisis. Then it, went down because of how bad the economy was. Then we had COVID. Okay, right? So now what are we faced with? And I think this time we are faced with, it's like COVID, it's a double whammy. I think it was COVID and then the 2022 with the interest rates and inflation. COVID caused that. And it was kind of like, the great financial crisis was a 4. COVID was a 2 and 2022 was a 2. You put them together, now that's just as bad almost as a great financial crisis in a way, right? I don't think it economically, it did not hurt us as bad as a great financial crisis. But my point is, it had large effects. But the Fed funds and certain other things are not reacting as if that's happened. They're reacting as if these have been little speed bumps. And it's like, well, no, we've compiled these things together in a short period of time. We're kind of hurting right now, and we kind of need these Fed funds rate to lower, but they're not lowering them. So you look at how much we're spending, the federal debt, there's no way that we're going to be lowering the debt. They want to raise the debt. They want to spend money. Well, no one wants to spend money at a high interest rate, not as a people, as citizens, civilians, and neither do the politicians and the government. They want to spend money at a low interest rate, and as long as the Fed funds rate is high, then so will the interest rate for government spending. So I'm also going to go over really quick the charts and why I think we could be seeing a little bit of a correction here in August, September, and possibly October. All right, now here are the cues since early 2000s, right? Now I have marked every single line down. Every single triangle is essentially the starting point going down is a 10% or more drop. And then obviously the line up is where it meets back to its previous all-time high. And then, it goes from there. And I'm noticing some interesting patterns right now. You have two different things. You have technicals and you have fundamentals. Technicals are going to be bringing you stuff like this, the patterns, the charts, right? The candlesticks, all this stuff. Fundamentals, you're looking at the numbers, the business model, right? You're looking at the income statements, the balance sheet, the cash flow. You're looking at all of these other things. I am looking at it from a technical perspective, not a fundamental, because fundamentally the companies are making money. They're doing well. Now earnings are now starting to come out. Some have guided lower than what was expected, but we're not hitting the big dogs yet. Once those come out, we'll kind of get a more clearer picture. But the point is that I'm looking at this from a technical standpoint, not from a fundamental standpoint. So recently, we just went through a decent correction. It was about 24%, and it lasted 48 days. Then we came back from that correction in 77 days, and we broke even, right? It was a total of 125 days that we just went through, right? That big crash of the tariffs, right? Since then, we have gone up now 4.6% in only 28 days. Now, that is pretty quick. We're not having a lot of news. We're not having anything great. Now we're having earnings coming up. When you look at all of these, right, this one is 4.6 in 28 days. This is a 7 in 85, right? So you're looking at 3.5 every 43 days or so. I mean, we're already over that in 28 days. This is, 23% in 174 days. Now we had a little bit of a drop. Right, that drop happened in about 80 days in there. And there was a little bit of a correction. And as you can see in here, we had a little bit of a correction. When I'm going through all of these, right after we break out of that triangle and we just keep hitting all-time highs, it seems like that we have a good stretch. A good stretch, right? This latest one, we're only at 28 days since we've hit all-time highs in the Qs. But we have 85 days, 174, 168, 56, 77, and 134. Like, we have so many days of after we reach, we hit an all-time high and then we go through a major crash or a correction and then we get back up to our all-time high. We usually have, on average, I'd say between 70 and 100 days. But we're only at 28 days. But we're also at 4.6%. Most of them, this is at 7%. Now, this one was a big one. We went through a horrible crash, but this is also only including after we reach our all-time highs. This is not including this other line that went up 56%. Then it also went up another 23% from there. But again, 23% from there, right? 20%, 10%. 27%, 25%, right? I mean, a lot of the times we have reached 20% typically, but it doesn't mean we get there so fast. we're looking at times 5, or about times, let's say 4.5, 28, it's about 30. We're looking at 120 days maybe, and we're at 20%. Now that is very possible. That's what we're looking at. But when you also look at all of these, big boosts that we're going for gains, we have a significant drop at some point, right? One thing that all of this reminds me of, I just have to say this, it reminds me so much when I look at the chart technically of 2008, like the whole great financial crisis, right? This would be our recent great financial crisis. When I go through all these charts, typically you do not have a triangle, right? A big drop of 10% or more within a triangle of us coming back to those all-time highs. Now we did with, in 2022 and 2023, all of that, right? All the inflation and everything, we had that drop. And as you can see, it happened at the tail end of us coming back up. Well, same thing happened in 2010. We had our major crash. And then as we're on our way up, we had a correction within, right? And then as we're coming out of it, we have 2 corrections fairly close, back to back. We have this one right here, and then this one, a big jump. I mean, almost 15% in 63 days, right? And then like a big W, and then we kind of boost out of that, right? But we had the 2 big back-to-backs, boom, right after, this major, we're recovering, and then we had 3, boom, 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 right in the tail end. Now, if you look at today, well, that looks very similar. We're coming out of this recovery, right? We're doing, boom, we hit a correction, and then fairly soon after, we had 2 big corrections. Now, after those, right, in 2013, right, in 2013, after that second correction and crash that we had a total of 518 days before we had another, before we had a 10% exactly crash, and then we go for another 259 days. So, we really, you could say for the next 819 days, we went up about 66% or something like that. That's insane. Could that happen again? Right? Could that happen again? Could we go up 66% over that much? Because, again, this is a technical, right? I'm looking at the technicals, and it looks very similar. The only problem that I have is the Fed funds rate. Like when you look at 2013 and all that, the economy, it was just different, right? It was different. That their environment, their setting, everything was different for them. They had lower rates. Right now, we don't have those rates. We do not have the rates like that to really boost our economy. 2013, even though the rates started to go up, it took 3 years for the rates to actually start creeping up. And even at that, you're looking at finally hitting 1%. That's the difference of today and the great financial crisis. I believe that could be the big shift in the technicals, right? We have a lot of things. Our economy is doing fairly well, but the Fed funds rate, right? People that have just too much debt, and it's, obviously the debt have higher interest rates. So economically, we're a little bit different. We went through this big crash, but our economy, our government saved by just flushing us with cash so much. Back in the great financial crisis, people were just losing their homes left and right. Granted, there were some bankruptcies and there was ways to get people out of the situation in some way, but we did not save the people the same way we did for COVID, which caused inflation to rapidly rise like the 70s, which that's crazy, right? When you look at the 70s, the interest rate was just all over the place. It went at the highest it had been, and then it jumped all the way to the low, the early 80s, and then ever since then, it dropped off. Now that was a big inflation boom too. That helped. So it's like, I just don't know if we're going to see these rates again. So I don't think we'll be able to see that kind of run. This run was magnificent. Going from April 2013 to July 20, there's just a 2-year span, and that was amazing. And even this little correction that lasted, 483 days, over a year, it was just still another boom after that, another boost. But even when you look at this, that's almost a year and a half of, not making money in a sense. If you went all in here, you still made money. You still made lots of money if you just held on for another 2 years. This is why you got to just keep investing. But again, I'm looking at these charts, and I'm saying, okay, I think we could run here for the next couple weeks. But something's gonna bring us back to reality. Now, I don't think it's gonna be at even something close to a correction of a 10% or anything like that. It might be like a 3 to a 5%, depending on how far we get into this rally. Right now, we're really running. The stock market's running, and it's running really hot right now because we went through a really crazy crash, and then we just came right out of it. So, I mean, the market is hot. So if it keeps going this hot, we could go fast. I think the faster we run, though, from here, the harder the next one's going to be in terms of bringing us back. Not a correction, right? Like I said, 3 to 5%. I think we're looking at more like a 2 to 3%. If we were to crash in the next week or two, or if the market were to correct itself, if we wait a month, if we don't get any of this until later August, I think the correction is going to be harder. I think the correction will be closer to the 5%, maybe a 6%. So we'll see. Obviously, I don't have a crystal ball. I don't know, but I'm just saying, be aware, be prepared. I'm looking at just the seasonalities of the stocks, and it doesn't look good. These stocks do not perform well in these months, and nothing tells me that they're all of a sudden going to magically perform. We do have earnings coming up. We have some that have lowered their guidance of some companies, not the big dogs. Tesla came out recently, actually, though, and did not announce anything great. Their guidance, they said they're going to have some rough quarters. So it's possible if these earnings come out over the next 2 weeks and they're not looking so hot, that could reel us back down and kind of bring us to reality and settle things down. If we get any more boost here over the next week or two with earnings coming up, I think we're going to have a decent sized correction, and not a correction, a decent sized pullback in the market around 5%. That's my guess. Now, I don't think it's going to eat up all the gains. Right now, we're at 4.6% since we reached our all-time high. So if we were to go down 5%, then we're going under that mark again, and I just don't see that happening. The pullback I'm talking about is not going to be a correction to where we go back to those previous all-time highs. That's not what I think is going to happen. I think it's just going to be about maybe half, again, depending on the situation. If we run real heavy right now, it can crash 70% of our gains that we have had right now, 50 to 70%. But if the next couple weeks of earnings come out and they're very subtle, they're kind of relaxed, they're not giving great guidance, but maybe guidance, and the stock market settles down, then maybe it eats only about 3% of the gains. I don't know. Again, just keep an eye on the market. These are some of the worst times, the weakest times for the market, so just be ready, be prepared. And when I say that, I also mean be prepared to buy. Always buy. Always have something to buy, but maybe don't go to get that Starbucks. Don't go buy this thing. Don't go buy that thing. And just have a couple extra dollars prepared to buy into the market when it starts to correct itself. So again, thank you for watching. I really appreciate it. Especially anyone who does get to these points of the videos. I have no idea who's even watching at this point. I really do appreciate it. I'm trying to give my best analysis. I am no stock market guru. I am no financial analyst, specialist. None of those things. I have had my success when I have focused on the market. I have done my research. I'm educating myself consistently. And I'm basing all this on experience. I have been investing in the stock market for 10 years. I've had some years where I've been up, some years where I've been down, some years where I stopped paying attention, and those were some of my worst years. And so when I pay attention, when I do my research, when I am educating myself, I do fairly well. So I just want to share what I'm doing, share my process. I got my $100,000 challenge going on. Go ahead and take a look at that. I'm going to be posting that on the weekend. Today's Thursday, so maybe in a couple days. I actually made some sells. I completely am out of 2 positions. Completely. I had 1 share each. But I'm out of those positions, and I'm planning to move that money into other ones. So I'm going to go over that in that video. And so again, thank you for watching. Really appreciate it. And don't forget to Earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.